You are listening to the ESG and Coffee Podcast on investing, strategy, and sustainability, hosted by Graham Sinclair.
I think by and large, I would say the same things, right? I would update some of the proof points around the index comparisons, debunking the trade-offs from thinking about low carbon portfolios versus, good ESG versus bad ESG trades and the like. But I think the core of the story is the same, which is that power has money. More so probably even today, not just because there is more investable assets in the world, but because of the fracturing and the polarization within governments and incoherent policy, right? So I don't want to say that it's up to capital markets to save us all, but I think that the power of capital has only increased. I guess the one thing that I would say, and this may be not what you're asking for directly, is that was really focused on institutions and asset owners. I would spend more time, or maybe shift the focus to real people.
I'm pleased to welcome our guest for Season 1, Episode 12, the last in Season 1. Our guest is Chris Mcknett. He is co-head of sustainable investing at Allspring Global Investment Management. Chris is definitely one of the originals. His bio reads co-head of sustainable investing, jointly responsible for shaping and executing on a holistic strategy for sustainable investing across the organization. He's a member of the Diversity and Inclusion Sub-Council. Previously, he was a senior environmental, social and governance investment strategist. Before that, he served as a head of ESG strategist for State Street Global Advisors, was a member of the firm's senior leadership team. Prior to that, he worked at KLD Research Analytics in Boston, one of the first research firms to specialize in ESG, and American Century Investments, where he began his investment industry career in 1999. He is a First Movers Fellow of the Aspen Institute Business and Society Program. Well, how did we first meet? I met Chris when I moved to Boston, Mass, in the winter of 2005. I recall there was a lot of snow. I was headed to be research product manager at KLD Research Analytics, and he joined shortly afterwards from Denver, Colorado, to work on the indexes side of the business. We were both new to Boston and had shifted our careers directly into sustainable investing. As Chris so kindly says, we've been friends ever since, and fellow travelers, collaborating in different work, moving forward ESG in investment land on at least 3 continents. So I'm very excited to end with the last episode of this season with my friend Chris Mcknett. Please enjoy this episode. And as always, ESG and Coffee is not investment advice. It's to understand and interview. Enjoy. In this episode of Season 1, the original, so the ESG and Coffee Podcast, I'm pleased to welcome Chris Mcknett. And if I quote him, he's co-head of sustainable investing at Allspring. He's jointly responsible for shaping and executing on the holistic strategy across the organization. He's a member of the Diversity and Inclusion Sub-Council. He's also a First Mover Fellow of the Aspen Institute for Business and Society program. But more than that, he's an alum of KLD, which is where I first met him in Boston back in 2005. Welcome, Chris. Wonderful to see you.
Yeah, Graham, thanks. It's great to talk to you. It's great to see you. And I thought you were going to say that more than anything, not that he's a KLD alum, but that we're friends. But we became friends at KLD, so I'll give you that.
There you go. It is a treasure. It's a great way to end this first season of ESG and Coffee, talking with a friend and a fellow traveler. So catch us up. Where are you sitting today? What's your geography?
Yeah, Berkeley, California, which has been my home since late 2016, after moving here from Cambridge.
Wonderful. And I've been taught some hard lessons over the last decade, so I'll begin at the beginning. How are you feeling? How are you doing? Are your friends and family well? We're living through a pandemic. How are you doing?
So, well, it there's a little bit more volatility, and I'm not speaking in investment volatility or market volatility, the day-to-day household volatility. And that has tapered somewhat, right? As we are now, 20 months into this new normal or whatever it is. Kids are in school, staying in school, which was not the case last year, all healthy, all vaccinated, and seem to be, not only keeping, but making friends and having things that you and I think had when we were their age, which is extracurriculars and clubs and leagues and teams. And that was briefly deprived for a while. So I'm really glad that we've turned that corner. So, we're good. We're more than muddling through, I would say.
Excellent. And if we could be in the same place, and if I wanted to be on an airplane, which I don't, one of my fun things about the pandemic is I forgot what an airport smells like. But if we were popping into your local, do you have a local coffee spot? What is it called, and what would I be buying?
So I do. Berkeley has good coffee and good coffee options. Berkeley is also where Pete's originated.
Right.
And the very first Pete's is not the closest one to my house, but we could easily walk there or bike there. But there's a Pete's that's about a half a mile away. You'd be buying me a medium roast with some steamed oat milk, which is what I'm drinking now, actually.
Ah, superb. I have a strong view on oat milk, but I'll say that for the bonus tape. Let me jump in on LinkedIn. My first reflection is I always try and look for interesting things for my guests. Not a lot of writing on LinkedIn, so just noting that. But you wrote, quote, this is in response to Hugh Whelan's big news around responsible investor. You wrote, you and the RI, you're writing to Hugh Whelan, you and the RI team have elevated coverage and interrogation of this arena in an admirably professional manner that balance telling it like it is with keeping us attuned to how it ought to be. We all here owe you and the team a mighty thanks. I thought that was really solid of you. I endorse those comments, of course, for the work that Hugh and Tony and the team have done for years. Did you reflect any in writing that comment a bit about kind of the changing of the guard or how long we've been working in the field?
I did. In many ways, the trajectory of RI, I think it really maps to the trajectory of sustainable investing, growth and penetration and adoption and embrace in the markets, right? So they were, kind of a small upstart, right? And I think they would say that they still are. And compared to, say, the FT, sure, they are, right? But look at how their coverage has grown, their readership has grown, their subscriber base has grown, the events that they put on, the quantity of them, the quality of them, the dialogue that they foster, the diversity of regions and topics and asset classes and actors in the investment change that they cover. I mean, it was really originally mostly a kind of European asset owner, asset management, and it's really a global hub for what's on offer and what's being debated now, in this big arena that we're in. So yeah, absolutely, job very well done, and I expect they're going to keep doing it, right? Because it was not just Hugh, but he was a force, as I think and many of your listeners would know, and if they don't know, they should know.
Yeah, I seem to remember. Maybe it was in 2008, one of the European events was in Amsterdam, and in this beautiful vaulted room, it might have been an old church or city hall or something, and then we all went out for drinks down some cobblestone street afterwards with a bunch of people. Yeah, there was both the content, the material that was coming from the platform, but it was also those early days of trying to figuring out, what are we doing, how are we doing it, how's it going for you, where you are, and their work was critical for that.
Yeah, and no doubt. And what I give them a lot of, what I have a lot of respect for is that it was more than like-minded people talking to like-minded people. Of course, I think that's where it started and how they built some critical mass. They grew the village and they brought in these other voices. And I now have colleagues that will send me articles from RI, and I was like, "Oh, you're reading that too? You're well done, right?" So their reach has grown. So that's what I meant by saying, that telling it not only how it is, but they kept it real. They pushed, but they kind of kept us in check and made us look in the mirror, and really sort of say, are we making the kinds of progress and gains that most of us are aspiring to make? And I just think, they've just done a bang up job on that. And now they've got imitators, right? So they've got a lot of imitators.
So to another Britain, I like to reference the work of David Attenborough, one of the icons, if you will. He's got that great show on Netflix that he did with WWF. And it helps tie to a little bit of what we've just been talking about the period of time. And something I like to call the tragedy of the horizons, borrowed from that Mark Carney speech at Lloyd's in 2015. And so I'm going to ask you, like I ask all my guests, to kind of reflect back on some data points. So I'm going to ask you the question, you'll give me the data point, and then we'll reflect. So firstly, and this begins with the first month or first year that you started working. And you may also want to remember with a smile what your first paycheck was and how many numbers were on that page. Right. So world population in the year that you first started working?
It's around 6 billion. This is in, I'll say it, this was in May 99. Now, this is the first time I started working in the investment industry. Not my first job, of course. But yeah, May 99 was around 6 billion. Okay.
And the S&P 500?
That clocked in at about 1,300. I think a shade over, 1,302. Thereabouts when I checked.
It looks like a spelling error now. Hey,
yeah.
Carbon dioxide in parts per million.
Well, it was where I think a lot of us would hope it would return to, below 400. It was hovering around 360, 370.
Yeah. And how does it feel to kind of look back and consider where we are now? And where we are now is, we're racing towards 9 billion. We're around 417 parts per million on CO2. And I didn't check the S&P 500 before I began, but I know it's a huge multiple on where it was back then. How does it feel to look back at those numbers and think, well, that's where your career began and where are we now?
It's unnerving to a large extent. And I'm particularly not commenting on where the S&P is at because, my personal net worth, has improved to a large extent because of what the S&P has done. But I think we have to not overlay, but compare that with these other barometers, population in particular, the PPM, the parts per million. That's gone. Those population is moving towards 10 billion, I think, by 2050. I don't follow it now. That's more consumption, unless we decouple population from BTU growth and GDP growth. That's going to mean just more pollution, more waste. And then looking at the parts per million, Graham, I wasn't paying attention to it then. So that's the good news. The bad news is the delta between then and now. The PPM. The good news is that the awareness, not only myself, but so much more of the capital markets are attuned to that, right? And I would submit that in 99, we could probably count, on a very basic calculator or an abacus or maybe even our hands, how many people in the investment community were looking at PPM. And now I would submit that there's hundreds, thousands, maybe even tens of thousands. Right. So that's the I guess that's the positive I would draw from that. But the trend has not been our friend.
Yeah. Okay, having looked at some kind of big picture, long-term things, I'm going to jump into fast espresso shot question set 1. We have 4 sets and we have 3 deep dives. So here we go with fast espresso shot question set 1. What is your earliest memory of investing?
Trading Places, Eddie Murphy, Dan Aykroyd. Brilliant, hilarious film.
Yes, and
that may not be investing. That may
right.
be more speculation, but it's related. So that would be the one. That was like 1983 or 4, I think.
It's based in Philadelphia, no?
Indeed.
Yeah.
At a commodities brokerage house.
Yeah, that's right. Question 2: what is your philosophy of investing in one sentence?
I borrow it from James Stowers, who's the founder of American Century Investments, which is where I started in May of 1999, which is, it's not timing the market, it's time in the market. So invest early and invest often.
Tidy, very nice. What switched you on to ESG?
Clients, right? When I was working at American Century, I was working the phones, a registered rep. Clients would call and make inquiries about social funds, green funds. I thought, what are those? We have a tech fund that's green, yeah. More questions came. So then I started doing research, scoured the web. What was the web at that time? Found this little firm called KLD that seemed to be at the intersection of everything. And that was the start.
Oh, wow. And how do you choose to define sustainable investment or investing with ESG factors in less than 30 words?
That, Graham, is maybe the toughest question you've asked so far. So for me, this is contemplating a wider set of information around what makes a company valuable and what kinds of value that a company creates financially, socially, naturally, in terms of the different kinds of capital, right? So this is looking at a more complete information set to form a more complete investment analysis, recognizing that non-traditional value drivers are a heck of a lot more influential over investment outcomes today than they were in 99. That was not 30 words, I apologize.
We'll check the transcripts and we'll issue a fine in due course. And last of the first espresso shot question set, what is your biggest investing mistake so far?
Well, this is a personal one. I'm glad to say it because it didn't affect any clients of ours. I've only bought one single stock in my whole life. Okay. I bought Apple. Thankfully, it wasn't a large amount because I was working at an asset management firm and there were limits. And I'm fairly certain that I'm one of the very few people who lost any money on Apple. I gave it more than a year. And I was like, I lost, I was underwater. So I took my losses and haven't bought a single stock since then.
That's called a sell discipline. Thank you for creating jobs for money managers all around the world.
Yes.
All right, so let's jump into deep dive 1 then. First of our 3 deep dives. Some are going to be questions about you, some about your shop, some about both. What does your job title mean? Co-head of sustainable investing.
So the co-part's easy. That means there's another person with the exact same title. This is my colleague, Hannah Skeet. She sits in London. And together, we are architecting and trying to advance an overarching sustainable investment strategy for Allspring Global Investments, my employer. So that means that we're working as a central strategy center, looking to create a vibrant marketplace for ideas about how sustainable investing works, how ESG factors can influence investment outcomes, the design of mandates, the client experience, increasingly and more recently, the real economy, if we're thinking about decarbonization and net zero in particular. And it's a partnering role. I don't manage money. I don't cover any names. I don't have that career risk, which I'm thankful for every day. And I've just given you a testimony to why I shouldn't, since I lost money on the one trade that I made. So what I don't do is manage money or cover names, but I work very closely with our multiple investment teams and all the partnering functions, whether they be legal, compliance, increasingly these days, product, strategy, and the client-facing apparatus, so our distribution teams, to bring this value proposition out to the marketplace, invite the marketplace into a conversation with us, and at the end of the day, just try and solve the sustainability and the sustainable investment challenges and problems that our clients are encountering. That's it in a nutshell.
And so let's do the hard thing, which is we both have younger children, elementary school, middle school children. Now, explain that to a 10-year-old, what you just said.
I've tried and I've failed miserably, so I was hoping that you could tell me, right, what I do. So look, it kind of goes back to the definition of sustainable investing, which was somewhat of a bungled effort on my part, Graham. But this is, for me, it's fundamentally about doing two things. One is helping our clients to earn the investment outcomes that they need and that they want to provide to their end beneficiary, right? Because at the end of the day, it's humans. And while it looks like one big institution, Allspring, another big institution, say a pension fund or a plan sponsor, at the end of the day, it's about people. And it's about providing returns or other investment outcome, could be yield, it could be income, that reflects the investment complexion or the world that they want to make, right? I think you've said something very similar to that, Graham, which I have shamelessly co-opted a few times, right? So this is about looking at investments in a way that thoroughly considers not just how much money they make or how many returns they generate, but how they make money, how they operate, and what are their stakeholder interactions, and what do those mean? And what do those mean to a company's results and a company's prospects? Right? That's not going to resonate with a 10-year-old. As I say that, I get that. But it's an attempt anyways. So look.
I was waiting for lemonade stand in there somewhere. Nothing about lemon. Good. Okay, so one of the questions I'm putting, my new course at Harvard Extension School, making a sustainable investing case, and one of the fundamental questions I'm having to answer for the cohort is, what do investors want? So let me put that to you. In brief, high level, what do investors want?
I'd have to boil it down to what are the most prevalent investor asks that we're getting now, Graham? I think the first one is that investors want to know, how do we, as Allspring, take account of these other factors that we're talking about, these factors and influences on investment outcomes and company performance that don't reside in the financial statements, which we refer to in the lexicon of ESG or sustainability factors and themes. They want to know, what are we doing about those? They want to know how we're doing the things that we say we're doing or not doing, but it's about the things that we're doing. So how do we take them into account? And they want to know what's next. They want to know what else should they be thinking about. And on that what next, the number one question is, what are the investment influences, or what is the influence on the climate transition, decarbonization to my portfolio, right? That's the most frequent and the most interesting and the most complex question that we're getting, right? Look, they want everything. They want their returns. They want brilliant service. They want very reasonable fees. And I'm really happy to say that increasingly, they also want this other. Now, I won't say that they want impact, right? Not yet, because I'm generalizing and thinking around the globe, right? But they're starting to bring to the surface an avenue of inquiry or a line of questioning that is looking at, you're allocating our capital on our behalf. So the on the horizon question is, what is that doing to the world? What is that doing to companies and the stakeholder milieu in which they operate in, right? Now that's nascent, but that's the question that's starting to come through. We have a long way to go, not only as a firm, but as an industry to adequately answer that, right? But that's work I'm really excited to do.
I've heard you before, I think it was your TED Talk, you helped to kind of pitch the hypothesis for sustainable investing by talking about insurance. Like, hey, of course, if you're facing these threats, then in a way it's buying insurance to consider these and include them in your investment decisions.
Yeah.
In 2022, and I'm happy if you want to reflect back, hey, a decade ago I was doing it this other way. But in 2022, if you're on a client service call or a first call with a new prospect or what have you, what do you see as really making them lean forward, really opening their eyes and start nodding? What pitch to them makes a lot of sense around ESG factors in investment?
The framing that I use to good effect is, look, this is about, I think there's a tendency which has compressed somewhat, but there's still a little bit of a tendency to think of all this extra financial stuff, all this ESG stuff, all the sustainability stuff as, yeah, it's important, but it's not financially consequential until tomorrow, right? T+1, T+2, T+29, right? If we're out to 2050, right? And I say, no, the markets pull risk forward. If we wait, well, not only will we miss the trade, and I don't use those terms, but we'll miss the return potential. But the negative externalities will have been built up so much that we might be in line with our peers from a alpha or a Sharpe ratio perspective, but we're providing returns in a world that isn't particularly worth living in, right? So if I boil it down, this is about managing risk today and preparing portfolios for the economy of the future. That's the short, like Twitter length, although I'm not on Twitter, but that's what I would use.
I think you can tweet that out. There could even be one of your posts on LinkedIn later today. It'll probably be your first post in the last 3 months. Gives me a chance, though, to mention your fantastic TED Talk. It has scored, are you ready for this? I checked today. 138,141 views. That's a lot.
Yeah, I think that might be the YouTube views on TED.com. I'm happy to say it's over 1 million. I've stopped checking it every day. Years ago, I'm happy to say, but I used to shortly after it came out. I've done other things since then, so I'm not hinging my self-worth on the view counts.
Yeah,
but
look, don't get me wrong. I was disappointed you didn't get a scene in Don't Look Up. I mean, I think they really missed an opportunity to bring you in on that project.
Somebody told me, my co-ed told me that I think you should take on the part of Jennifer Lawrence this year. Like, I haven't seen Don't Look Up, and she's told me about it already. So I'm like, I suppose I have to really see that film.
Yeah, you have. We can say that for another coffee chat. It's that. But yeah, that was an important YouTube, whether you're watching YouTube or TED or what have you. It was important, and I'm glad it stayed there. Now I'm mindful. Mine was just a TEDx, and I did mine in October 2013. You did yours in November 2013. I'm mindful of doing another version with looking at basically the same frame of what I said, but just updating all the data, and it'll kind of give me a picture of where we are now.
Yeah.
And when I kind of go back and kind of laugh at myself and point out what could have been better and so on. Can I pitch you on doing a remodel for 2023 of your TED Talk?
You could, Graham. If you were to ask me, what would I say differently today? Going back to your earlier question about how do I think about, population and PPM, et cetera, from 99 versus now, I think by and large, I would say the same things, right? I would update some of the proof points around the index comparisons, and debunking the trade-offs from thinking about low carbon portfolios versus, good ESG versus bad ESG trades and the like. But I think the core of the story is the same, which is that power has money, more so probably even today, not just because there is more investable assets in the world, but because of the fracturing and the polarization within governments and incoherent policy, right? So I don't want to say that it's up to capital markets to save us all, but I think that the power of capital has only increased. I guess the one thing that I would say, and this may be not what you're asking for directly, is that I was really focused on institutions and asset owners. I would spend more time, or maybe shift the focus to real people, right, if you will, individual investors. Although this gives me a chance, Audrey Choi from Morgan Stanley did a talk that focused more on the individual investor, which is brilliant. So she's already covered off on that. Nice. But yeah, let's do it. I mean, let's talk about the next thing.
Excellent. Well, one big thing that's changed a lot, which I didn't foresee, I'm not sure if you foresaw, when we were watching it play out in a different direction in Q1 of 2022, but the huge piece that technology and kind of makes up of the whole market cap. So I picked up a data point, the so-called FANGs touched $10 trillion in AUM in July 2021. So that would have gone up and then slipped a bit this year since that data point. And it's roughly 50% of the entire US economy. So I don't know about you, but the older I get, the more questions I have and the fewer easy, clear answers I have. How can you think aloud with me a little bit about how we do our job in the context of these stock markets and the dominant piece of that's played by the digital economy companies, if you will?
Well, I think it sure gotten a heck of a lot harder, right? That concentration of investor capital resting in so few companies, the influence that any one investor or any two investors or 3 or 10 investors can have on altering the trajectory or shaping the behavior or the ethos of those companies has to be diminished, doesn't it? Right. So I think it speaks to the really important role of collective action in industry fora, where long-term investors, are working together on long-term themes, right, to protect client capital and to grow client capital and to make these companies resilient and endure, right? And the other thing that I think is interesting, and I haven't done the work on it, but I've read something about it, Graham, is that only works to the extent that those companies rely on external financing, right? They're so profitable, retained earnings, they don't really need, they don't issue a lot of debt. And, equity capital, it's in abundance, right? So there's limits, I think, but what's your view, right? I think consumers, it also comes down to aligning with the consumer voice and the consumer signal, and we're starting to see that in the employees. So I don't know how we cross those lines and work with the consumers and the employees.
Well, for me, the positive, like Kate Brandt working at Google Alphabet, is that when they do something good, it's industry building, right? So if Google's buying X amounts of power or they're trying to go negative carbon at some point in the near future, that's a very powerful signal, and that's a huge, well-funded client who's going to pull that industry through. Personally, I'm a fan of Stripe. They're not listed yet, but I've been watching them closely for years, Patrick Collison and his brother. And what they've done around direct air capture has been formative. In a way, it's borrowing from the model out of the infrastructure sector, or even back to my work at the Global Alliance for Improved Nutrition, where we looked across at the Global Alliance for vaccines, which has shown up through the pandemic. But it was a case of trying to fight pandemics and trying to get funding from pharma companies to tackle diseases that rich people didn't have as much, particularly in emerging markets and the developing world. Well, the only way to get manufacturers to make that was you'd promise an offtake. You would buy X million units of these things. And so the one upside I see, again, if it's in the right direction, it's a good thing, is where someone like Stripe is basically with Microsoft and others trying to fund the direct air capture industry, and so I see a positive in that. But concentration of power in a market is not a good long-term thing for markets.
Right. I think it doesn't, but that's when the regulators ought to step in, right? Not in the trust busting sense of the world, in the word, but maybe a more contemporary analog to that, right? And then there's disruption from upstarts,
right? Sure.
Right. These companies. One thing that they're exceptional at is, I think, thinking every day about who's going to disrupt them, and what to be mindful of, where to place their bets, and but what's happening is they're buying those disruptors and adding to their balance sheets, and their patent potential and the like. So look, I don't criticize them. They've been phenomenal for investors over the long term, right? So let's just hope that investors continue to do the work, whether it's through valuation or through engagement, using their voice to their vote to express their points of view, and keep sending that signal to companies that it's not just how much money they make, how big their margins are, it's how they do it, and what are the externalities, positive or negative, that go along with that, right? And that's where so much more of the markets, as you and I both know, are focused on these days. And so that's just become more and more important.
And I'll pick up something more when I talk to stewardship and proxy voting in the next segment. We'll pick that up again. Let me take a moment or two just to pull out some details in terms of what you do and themes. Are you working directly with strategies or with funds? Like, what is the intersect between you and the portfolio managers or the analysts? So are you in charge of a certain geography or themes, or how does your role fit into the shop?
Yeah, so I'm really lucky. We at Allspring we're managing really across the waterfront of liquid asset classes, and across equity, fixed income. So it's growth, value, core, large, small, developed, emerging, fixed income, big money markets business. So liquidity portfolios, 1 year or less duration, investment grade, high yield, sovereign, and both fundamental and systematic approaches. And so sitting centrally, I get to work with, on a day-to-day basis, numerous investment teams. So I get wide exposure to those teams. And so we, of course, do spend more times with the teams that are looking to develop mandates, like for institutional clients that we would invest through a separate account, that would bring together, let's just say the excess return objective of the strategy with a sustainable outcome. It could be climate, it could be something approximating the sustainable development goals, or other different flavors, or companies that want to, or the teams that want to develop particular products, right? So a commingled vehicle or a commingled structure. So all of it really does, Graham, rest at that intersection of what is the client looking for, what's the client experience, what are they asking for, and how are the investment teams positioning to deliver that. And the really exciting work happens, when we start from first principles on a whiteboard in a room, these days in a Zoom or a Teams chat, and we do R&D and we iterate that and we move it through the development process, and get that out to the client and hopefully win that mandate or get that product launched. So it is very much an iterative, dynamic process with the investment teams. The really cool thing for me coming here from State Global Advisors, this is a much smaller firm, but the complexion of the assets are much different. A lot more fixed income and about 99% active, right? So the number of investment professionals is it's very large, and the brain power, the intellectual power that comes from that, I've learned so much, and if you meet someone, this happens less now than it did 3.5 years ago, Graham. But the most exciting thing to me is meeting with the portfolio manager or an analyst, or sometimes you meet with them together. And then when I first started, I would be doing a lot of the talking and the explaining and saying, interpreting, this is what the market wants, or this is what that client wants. And then that's the first conversation. Then by the third conversation, you're doing the listening and they're doing the talking, because they've gone off, they've done the work, they've built models, they've dug into the research, they've dug into the data, and they're energized, right? And now the learning curves, both ways, both for me and for them, are super steep. And, that's a really fun environment to be a part of.
That is excellent. Earlier today, I was talking with Isabel Gilliard-Thompson at DNV in Oslo, someone who's been doing this also for a couple of decades, high quality work. And she was, we were discussing oceans. Norway's got a very strong ocean economy. They got the fish farming, they got the transportation. And I was referencing the work by Dan Vermeer and others at Duke Fuqua. They do Oceans at Duke webinar every month. Would someone bring an idea? So say I came to you and said, hey, Chris, why don't we do an ocean theme? And that means we need to look at these financial factors, and we're looking at family owned, privately held, listeds, and then, can you cover the ESG piece of this, and we'll push us out as the ETF? Like how would the conversation go?
Yeah. So that's I'll put it to you this way. So we, as active managers, or as an active house, the 11 of us that do ESG stuff day in, day out, full time, we're just a nucleus. We're a catalyst, right? So if we were to, I haven't done an FTE equivalency of how many humans and people are doing ESG work throughout the day, but I'll put it to you this way. Our view has been that a great fundamental analyst can be an excellent sustainability analyst, right? So we wouldn't build a research model or sector research or company notes and then sort of pass that off, to that investment team that's competing for that mandate or competing for that opportunity. We would co-architect the framework, the assessment framework, to ferret out those investment decisions, build that together, get it tested, right, and validated internally, work through the product development or the sales cycle, depending on the vehicle in which it comes to market, and then once it's stood up, right, it's now in the hands of that investment team. And the tech teams or the compliance teams that would be checking and monitoring it. We'd stay involved to fine tune it, to calibrate, to communicate it, to talk about to the market, to discuss extensions, modifications. But that's how that process would go, right? So this is very much a joint exercise where we are sort of as co-architects, and then we partner with the skilled craftsmen and craftswomen in the form of our analysts and portfolio managers who then have to go and implement it.
And then building on that, so the obvious question, buy or build or both. So what do you do about ESG data? Because there's different views, different kinds of shops are shaped in different ways. If you got a wide portfolio, you're going to pull something from a vendor and go an inch deep. If you got a concentrated portfolio, maybe you're going to roll up the sleeves. And as you say, the fundamental analyst can cover all that ground because they're looking for something special anyway. Yeah. So what's your answer to the question, well, where are we going to get the ESG data and how are we going to analyze that?
Yeah, well, so we take a pretty wide approach to that, Graham. And what I mean by that is we're not wedded to a particular vendor, but we absolutely do source third-party ESG data, research, information, ratings, whatever you want to call it, all of the above, including climate and carbon. And that data procurement and data acquisition strategy is expanding, right? Just because as you know, there are shops that go broad and think about ESG in a wide sense, and then there are more vertically oriented who are looking at, say, physical climate risks, or looking at, say, the muni sector. So we source multiple third-party data sets. For us, we don't drive an investment decision off what that third party says. It's purely a starting point, right? Because we know everyone says, oh, they're correlated. They say different things, they reach different conclusions. We know why that is. There are a lot of smart people who can tell you they measure different things or they measure the same things differently, right? I think that's what it boils down to. But as active managers who are intimately knowledge with the companies, the management teams, who are it's their job. Their job depends on knowing the industry, operating environment, and the competitive dynamics. They're in, regular, daily, in some cases, usually not daily, but in frequent contact with the companies. So in other words, they are privy to near real-time information, right? But that third-party view is incredibly important because we want to understand what the quote-unquote kind of market consensus is. What's the street view on these names? And then we want to use that to layer in our own points of view and build our own frameworks, right? So we're more interested in the data points as inputs rather than the answer, right? So we've constructed a bunch of different frameworks to try and suss out what we think is the truth that leverages that third-party data, but isn't necessarily wholly dependent on it.
In a way that reflects back to our origins at KLD. So we always presented the content, the wide range of the performance, but we didn't roll it up into a rating. And there's a recent paper by Bob Eccles, Linda Eling-Lee, and Judith Struhl from Oxford that talks about the social dimensions of ESG. I'll share the paper with you and I'll put it in the show notes. But it's a fairly pointed clarification / rejoinder to all the research that's been done over many years that fails to make the distinction about what is data and what is analysis and when are the analysts or the researchers making decisions. Right. Which is all the way up that vertical. So I'll share that with you. Right, we're running a little late. Let me jump now to close deep dive 1 with the pricing pollution question. Again, a lot of words. We're trying to work really hard to move things forward. One of the most clarifying questions I found myself asking or having conversations about today is, so what's the price of pollution? So let me pose this question to you and see what your answer is.
Graham, this is sorry to interrupt. This one's a skip for me.
All right. Okay. Fair enough. We'll pricing
pollution. That messes your role.
Another day.
You are listening to the ESG and Coffee Podcast on Investing, Strategy and Sustainability. 您现在收听的是 ESG 和咖啡时间，投资策略和可持续发展。
Let's jump to Espresso shot 2 then. Another set of 5. You ready to go?
Yeah.
Good. Question 1. What app are you most likely to be viewing on your smartphone while waiting in line?
It's either my health app or the New York Times.
What book did you enjoy reading recently?
American Wolf, I read on my own. A joint reading exercise. I read the whole Harry Potter series with my oldest daughter. It was kind of a pandemic father-daughter thing. And then we watched all the films. Very pleasantly surprised with Ms. Rowling's characters and plot lines.
Yeah, it's amazing. And some of those actors, yeah, that was lovely. We stumbled on the Stephen Fry narrated version, the British version.
Yeah.
We look on tape. Lovely. Good. What is the best kind of pie?
Any pie that my wife makes, but my personal favorite is pecan pie, which I don't have often because I'm the only one in the family who likes it.
Wow, nice. Fun fact, my mum used to bake and sell, and pecans are expensive. Not a lot of people know that. Like, yeah, there's a business for us there one day. What is your favorite movie or on-screen moment that relates to the world of investing?
Wall Street, when Bud Fox falls from grace and realizes that he wants to work with the airlines and the unions to take back ownership. That pivot and that dramatic arc was just brilliantly done by the film. So that would be it. Second would be Trading Places, just for comedy. But yeah, Wall Street.
Okay, well, good one. And as an investment professional, what is your most meaningful success so far?
This would be at my former employer, where we came into a deal with a very large multilateral asset owner who was looking to fund a low carbon exchange traded fund. And there was a very serious competitor who was in the pole position. And we came in, we made I think a better pitch, and they ended up splitting the mandate with us and giving us seed capital to launch the first global equity low carbon ETF in the US marketplace. It was around 2014.
Man, well played. Is it still going?
It is still going. Yeah.
Wonderful. You know, because I've told you, and we're talking about this separately in my Harvard class, I'm using the gender diversity ETF from your former life as well. That's a conversation for another time. Right, moving on, deep dive 2 then. Again, a range of questions pulling from your brain and what you do on a daily basis. Easy question, maybe hard to answer. Where do investment ideas come from?
I don't know that is an easy question, because it's not an easy thing to do. And that's one thing that I've really come to appreciate working at Allspring. And, I mentioned that it's an active house. I used to have a real index bias. I didn't tell anyone that when I was hiring, interviewing rather, to come over to Wells Fargo Asset Management, which is the predecessor to Allspring. And now I don't. So I think investment ideas come in part from institutional memory, past experience, collective cognitive diversity on investment teams, and really, I think, looking around the corner, Graham, to what's next, and who's influencing what's next. And what I mean by that is, we could put that in a stakeholder capitalism framework. We could look at that as a regulator dynamic. We could look at that as this code red for humanity. Secretary General Gutierrez, I think is how you pronounce his name, has said about the climate emergency. So it comes from keeping your knees bent and looking up, right? I think you've got to pivot from head down in the models, in the spreadsheets, to lifting your head up, talking to your clients, looking at the news, and checking your biases, right? I think that those are where they come from. I'm lucky because, again, I don't have the career risk to have to generate the investment ideas. I just help to get them implemented and executed efficiently.
So moving forward then and reflecting very quickly on the kind of the COVID pandemic experience and the economy, and a whole lot of things happened, and money was let loose to try and keep the economy running, what have you. George Serafin, the professor at Harvard Business School, did a paper, and they looked at 3,023, the largest publicly held companies in March 21. And they looked at, the companies that did better were ones that had a better environment, social, and governance. Yeah. It's a small amount, but it was there for a very narrow window of time. So to set up this question, in your work around environment, social, and governance factors, have you found that are you doing different work? Are you thinking about your role differently? Have you seen things play out over the last 20 months that have made you change or adjust how you explain what you do and the impact of what you do?
Yes, it's still playing out, right? Because as you pointed out, it's a decent amount of time, but it's not anything that I would describe as conclusive. I would say this, Graham. First, what the pandemic provided and the shock to the markets and that dramatic, precipitous decline proved that sustainable investing has staying power that supersedes any market cycle. And that was a very quick and dramatic cycle, right? So it is not. So what it has proven is that sustainable investing and taking account of ESG factors to influence investment decisions is not a bull market luxury. The second thing that it's really illuminated in my mind, and I think increasingly across the market, is the social dimension, particularly human capital. And we've seen employees, I think, start to command more bargaining power. Now, I'm not talking about unions per se, but I'm thinking about employee scarcity and the quits rates, and the attraction and retention of people, what we call human capital, really matters. And also the diversity quotient that exists within companies, not just in terms of the complexion of their workplace, but how they deliver their services, their products to the marketplace. Are they looking at potentially reaching new marketplaces by changing some of the narratives around how they communicate what it is that they do and what's useful about it? That has come to the surface dramatically. I hope it stays. I think it will. And the other thing, which is very much related to each of these that I said before, is I think the companies that Larry Fink just said this, it was sort of about corporate purpose, but you're seeing companies that have a purpose that is more expansive than, say, helping clients succeed financially or whatever, right? Are the ones that have this compass and have this ballast within their operating environment and the four walls of their companies to keep going, to keep attracting customers, to keep attracting and retaining talent, to keep attracting and retaining investment capital. So the companies that are purpose-built, purpose-driven, I think have been shown to thrive during these times of extreme stress and ought to continue to do so going forward. So we're working on illuminating those in the context of our analysis. That doesn't come out of a data set, a lot of that, right, as we know. So it comes through dialogue with companies. But that's been a focal point of how we engage with companies during and since the pandemic.
I heard the CEO of Deloitte on a Bloomberg event yesterday say, the question was, so why are you looking at these things? What's the business case? Or why are you doing? And his answer was 87% of his staff want to talk about climate. They want to know that Deloitte is working on climate. They want to know, what are we doing? Are we doing something? How are we doing? And so his answer, it was a very compelling answer, he's like, 87% of my staff want to do it. Guess what? We're going to be talking about climate. We're going to be figuring out what we do. Yeah.
for them for knowing that 87% number.
Yeah. I want to try another quick one on you quickly. Double materiality. Is that something you're dealing with?
Yeah, we are. We deal with it in the.
So sorry, Chris. Before you answer, so let me set you up, because I don't fully understand. I heard a lot about it.
Yeah, you're gonna ask me to define it.
So explain to me like I'm a Labrador. Here I'm role playing Jeremy and Martin Cole. Explain it to me like I'm a Labrador. Double materiality, please.
Okay, I'll do my best. Right. Two sides of materiality. That's the double part. Materiality means salient or important. And it's two different lenses or transmission channels. One is how do social environment in particular, and also governance, affect investment returns, investment decisions, investment outcomes, outside in, right? The other side is inside out. How does financing and investment decisions affect the real economy, i.e. contribute to positive social or environmental or negative social or environmental outcomes, right? So outside in is traditional ESG integration, as some of our listeners might think of it. Inside out is that second bottom line, right? What is the impact to planetary and social sustainability? That's the best I can do. I don't know what it means yet or what it's going to mean, from a practical perspective, right? But I think that's what it means. That's my best effort.
Good man. Let's move to something you'll definitely know about: greenwashing. We're coming into deep dive 2. We got our espresso shot question, and then our shortest deep dive 3. So it's about greenwashing, right? So 2 questions for you. Do you agree greenwashing is real, and how does it hurt the work that you do?
It is real. I don't think it's as pervasive as the popular narrative would lead one to believe, but it is real. How does it hurt the work that I'm doing? I don't know that it does, Graham. I actually think on net it's probably helpful to the work because it enforces discipline, that one has to, say what they do and do what they say. And importantly, be prepared to evidence that and document that in some way, shape, or form. So I'll put it to you this way. I've probably been guilty of greenwashing in my career. I'm remembering a time when I was at my former employer and we created a fossil fuel-free exchange-traded fund. We did this right on the eve of Paris 2015. We were thrilled about it. Fast forward a few months later, some capital markets and NGO actors said, hang on a second, this isn't fossil fuel free, right? And they were right. It was fossil fuel reserves free. So it was a surgical interpretation of just stripping out companies in the standard index that didn't have an economic interest in reserves. So guess what? We changed the name, fossil fuel reserves free. So I guess I have been a party to greenwashing. We have now at Allspring a municipal sustainable fund product that we are very careful to say is not an impact product. It is a sustainable product because we are looking at issues, so specific issues, and trying to assess their contribution to positive environmental or social outcomes, either from an environmental perspective or an underserved population perspective. We're also looking at the issuer's track record on those same dimensions. So you could argue that there is an implicit impact thesis, in that investment product because we are intentionally and only investing in issuers and specific issues that we think are going to contribute. We don't call it an impact product, right? Because we don't have ex ante targets that we're particularly managing toward, whether it's greenhouse gas avoided, megawatts renewable energy, school desks installed, hospital beds, and we're not reporting on that ex post, right? That that kind of behavior has gotten ahead of itself. I think a lot of impact reporting is spurious. It should be taken with a very healthy dose of skepticism. So I actually think that this greenwashing is going to really enforce a lot of discipline in the marketplace. And what it's really doing, which I don't love on a day-to-day basis, but it's meaning that I'm getting a lot closer to my friends and colleagues in legal and compliance. And so it's increasing the acumen that resides in those critical functions in asset management firms to upskill and build their own knowledge so that they can sniff out that greenwash test. And building controls to mitigate it. In the long run, that's going to help me, that's going to help clients, it's going to help the market. It's a little bit of pain now, but I welcome it. Right? It's time.
I'll take the positive. I hadn't seen it like that. So yeah, thank you. Oh, that's encouraging. I agree. So
You're listening to the ESG and Coffee Podcast, hosted by Graham Sinclair. Sie hören den ESG and Coffee Podcast. Ihr Gastgeber ist Graham Sinclair.
So let's come into land espresso shot set number 3. You ready?
Yeah, let's go.
Here we go. 1. Do you have a favorite type of tree, and what is it?
Any tree that I'm looking at.
What one on investing would you recommend?
What one book on investing? I have to confess, I've started several of them. I've never finished a single one. So whichever one that you think is readable, start to finish, maybe it's your next book.
I love that.
No, not including textbooks. I had to read the textbooks, right? So textbooks.
I'm not worried your professor's watching. Your own retirement fund invested.
So it's self-managed. I'm a DIY investor. It is a mix of index through ETFs, because I think expenses matter, but a very healthy dose of actively managed mutual funds and other types of structures. It is not 100% sustainable, as Morningstar would tag it, but it is about 75-80% sustainable, because I am looking for exposure in certain asset classes where there is not a good selection of products and offerings there.
Nice. What would your advice to yourself at 17 be today?
This is no bearing to investment, at least no direct bearing, at least as far as I can discern in my mind. But I would say, when you go to university, college, as I called it, but I know you called it probably university, Graham, coming from your country of South Africa, the great country of South Africa, go abroad, study abroad, and work abroad if you can. And my one regret from my college days is that I didn't study abroad, and I would tell any 17-year-old that myself. I'll probably tell my kids that as well. That would be the one.
Very good. Moving to deep dive 3, espresso shot, Goldilocks question, and some bonus tape. Deep dive 3. I think the concept of ESG alpha is unhelpful. I don't think you can glob ESG all together. I think it happens across a shop, shows up in different ways. And the whole chase to try and find this alpha and outperformance, which if you believe in any kind of markets anyway, it's going to get traded out. So quick check with you. I'm declaring my bias in my position. What do you make of this ESG alpha argument? Is there such a thing? Can you hold it? What do you think?
I'm with you, Graham. I think it's, something of a red herring. I don't think that you can do a proper, Brinson attribution to isolate the ESG signal and the connection that you can do with, other factors that are empirically validated over decades and decades, right? But think about that, right? Pharma French has history going back to 1926. What do we have? An eclectic hodgepodge of ratings and scores and indexes that started in the late 80s at the earliest, probably, right? So yes, aggregating ESG into a single score. I get that is something that arguably needs to be done. It's not terribly effective. You've got to break it into its subcomponent pieces. I much prefer to look at the performance of sustainable funds, as Morningstar defines them, to other funds in their exact same category. So small cap sustainable to small cap vanilla. Look at their performance, risk adjusted, 1, 3, 5, multiple time periods. That tells you, I think, more than you need to know, rather than did the excess return or did the return differential come from the fact that it's sustainable or not. I don't buy it, and I think it's a little bit of a fool's errand. I would like to see someone develop precision to get at that, but that's my long answer. Sorry. Short answer is you're right. For once.
I'll bank that. That's on tape. I'm not deleting that. So last of the deep dive 3 then, engagement. What is the one thing you wish investors and companies knew about engagement that they don't really fully understand today?
I don't think it's a numbers game. And I mean that in 2 ways, right? I don't think it's important, or rather it is important, but I think the importance is overstated on the size of the team of stewardship professionals, say, that exists at massive asset manager A versus asset manager B. And that makes a big difference. I don't think it does, right? Touch points matter. You got to spread your signal around. So if you're talking to 5,000 companies versus 1,000, sure, that probably has some benefit. But you have to dig deep and take the time and have recurring engagements. So that's one dimension, the numbers, that I think is not well understood. The second is the votes matter and the voting patterns matter, but it's not all about the votes cast, right? Because the votes, in many respects, are the endpoint of an engagement, of a dialogue, of a path of research that is done, right? So the votes and that engagement count, need to be taken and considered in context, right? I think that's probably the one thing that is not terribly well understood, and too much stock is placed in how did manager A vote versus manager B. I'm not saying it's not important, right? I'm just saying that that's not the ultimate arbiter of how diligent or attuned an asset manager is to any particular issue or topic, right? Because companies are very heterogeneous. They're at different stages of their evolution, their strategy, their capital allocation, et cetera, et cetera. And active managers who own these names because they like them for at least one reason, and usually multiple reasons, often want to give these companies the benefit of the doubt, right? But it has to be earned, right? It's not a free pass. That's the other thing. That's why I think that the numbers overstate the story. People may not like hearing that, but that's how I feel.
It's the nuance. It's why we have conversations like this. So let's come into land then, wrapping up Deep Dive 3, ESG in 100 Moments. I'm writing a book. Gene Rogers encouraged me to go ahead and write it. The history of ESG and investment in 100 moments. If you open that book, you read that book, you say, Graham, this moment has to be in that book. What would your moment be?
I think it'd be September 2005 when we met.
Let's bank that. And
yeah.
a fantastic photo of the two of us looking out a window. Done.
Well, look, that may be if you ask me in 2 years what investment book I might recommend, hopefully that'll be the one. For me, I think it's got to be 2006 when PRI went live, right? I think Freshfield's, that opinion, was that written in 2006 as well?
Yeah.
So why that's important, right? There was a lot of tribalism, if I can put it to you that way, before then, right? Where there were, initiatives here, like SIFs or social investment forums in this country or this market. There were investor initiatives that were somewhat sclerotic. They were important. I'm not diminishing them, but it seemed very tribal in a way. What PRI came in, and they built the big tent, and they put up that tent pole, and it really globalized it in a way that was, frankly, inclusive. And I think that set in motion this chain of events, which accelerated slowly and then very quickly in the last 5-7 years, right? So for me, that would probably be the one that there's many, right? You're going to have a hard time choosing 100 gram, but to me, that's the one.
Got it. All right.
You're listening to the ESG and Coffee Podcast, hosted by Graham Sinclair. Вы слушаете ESG and Coffee Podcast. С вами Graham Sinclair.
So having wrapped Deep Dive 3, here we go with Espresso Shot question 4. Again, quick answers. Here we go. You ready?
Yes.
What is your favorite word?
Dad.
What is your least favorite word?
Synergy.
What profession, other than your own, would you like to attempt?
Park ranger.
What profession, other than your own, would you not like to attempt?
School teacher, because I got a taste of it for a couple months when I was in the AmeriCorps, and boy, those folks are underpaid.
Agreed. What attribute does an excellent investor have?
One attribute? Patience.
Very good. Which living person do you most admire?
Well, that depends on when you get asked that question. I'm gonna do a cop out and say there's two: Mark Carney and Greta Thunberg. I like Mark for the forceful clarity in his authoritative position and the way he speaks about it. And look, Greta is a hero. Blah blah blah. Let's stop the blah blah blah.
There you go. That's a rap I can get behind. What is your greatest extravagance?
I am partial to a expensive bourbon or scotch from time to time, maybe a little bit more than time to time.
Single malt, Irish, Scottish, Japanese?
Yeah, I haven't gotten into the Japanese yet, but next time we get together, maybe you could expand my horizons. Certainly scotch, and there are some exceptional American bourbons that I love, probably a little bit more than scotch. Scotch I like to have as a real special extravagance, but what's in my pantry today is a very good American bourbon.
I look forward to trying that with you sometime. Which talent would you most like to have?
Well, I'd like to be able to play music. The other piece of advice I would give to a 17-year-old is learn an instrument or learn to sing. That's my other regret, is that I always skirted that opportunity in school. I'd love to have some musical talent. I cannot, my voice, you might think I could be a singer. I think I could have done a barbershop or like a bebop, just the bass, but I can't sing. I can't keep two different beats. So I'd like to be able to play an instrument.
Fair enough. What do you consider your greatest achievement?
It's got to be my most important job, which is being a father to my 3 kids. And not just being a father, but being the kind of father that I hope that my children will be. 2 of them are daughters, so they may not be fathers. Things may be different then, who knows? But the type of parent that they will hopefully be to their children. That I think I'm on a reasonable good trajectory there. So we'll say that, Graham.
Yeah. The movie Postcards from the Edge always makes me remember that the child gets to write the story. So I think I need to write my side of the story to publish soon after. And the last of our 10 questions, what is your idea of perfect happiness?
Outside, in a forest, with my family, a camping chair, a tent, a fire, some good camp food in my stomach, and maybe a good beer or an IPA in my hand as I sit around the fire.
All right, done. I wish that for you. I wish that for
Yeah.
you this summer. Right, moving on then. You get a chance to ask the audience a question. So power of one, I like to call it. What can we do about making sure ESG factors on every investment decision? So could you give us one idea, one call to action? What would you like all humans, starting with me and others, to do?
Well, what? I would say, Graham, this idea isn't entirely my own, but one of our very large asset owner clients asks us a lot of pointed questions. And one of the questions is, what kind of training do your investment teams get on ESG and sustainability? Because this has not been institutionalized in the curricula that they have come up through, whether it be business school or the CFA Institute. Now that has changed to a great degree, as I think you know, particularly with some schools, and the CFA is making great strides. But I would say that this has got to be embedded into undergraduate level curriculum. When they're studying economics, they're studying commerce, they're studying finance or any other related discipline. We have to bring it through to the very foundations in the very beginning. So maybe that's a textbook idea for you, high school economics book.
You just gave a sales pitch for my new Harvard Extension School class, because it's not that expensive. And you're a teenager.
Oh, I walked right into that one, didn't I?
I didn't see that coming. I thought you were going to go about coffee or ice cream or something.
Yeah.
Right, to the Goldilocks question, our last question. Tesla Incorporated is an American electric vehicle and clean energy company based in Palo Alto, California, driving distance from you. One share of Tesla, TSLA, trading on NASDAQ today, before I did this call, is $959. If I had spent my money on the stock and not the product, yeah, which is down 4% for the day though, so it's been quite the start to the year. So, Goldilocks question, is that too high, too low, or just right?
A, I don't know. B, my guess is, judging by the number of Teslas that I see in my neighborhood, which may be commentary on my status, or maybe not. Berkeley's liberal. I see a lot of Priuses too, and the number of Tesla vans, or what is it, Sunrun or SunPower, that are doing rooftop PV installation, and installing battery packs for backup storage on the walls. Given how ubiquitous they are, where I spend most of my days, it's probably fair, right? It's probably fair. Now, that doesn't mean it's cheap, but it's probably just about right. Disclaimer: I don't follow Tesla, and that's not investment advice or any sort of recommendation whatsoever.
Fair enough. We have our disclaimers at the top of the show. So you've been a fine guest, Chris. As always, it's always great to see you. Do look forward to having that drink together sometime. You're one of the originals. Thank you for the hard work that you've done over many, many years in the practice of investment and ESG. I like to say the investments you make become the world that we all live in. So thank you so much for trying to make it a better world.
Graham, it's my pleasure. You're one of the originals too, and you were a fine host. So right back at you.
Thank you.
And now we keep the tape rolling to hear from Graham and his guest as they reflect on their discussion and anything they wanted to add.
And now we take a minute or two with our bonus tape. The guest and I can kick back, finish up some of our coffee, and cover anything that we wish we'd said or said differently, or just remembered a fact that we want to drop in. Chris, I know you're tight on time, so anything you'd like to think back on or add, or we wish we'd talked about?
No, I think, well, maybe there was one question that you said, something along the lines of what names are held in your portfolio that people might be surprised to know about. I don't know if we've got time to go into it, but that was interesting because we've got a climate transition credit strategy. So it's investment grade credit. And what we're doing there, Graham, is that, sure, we absolutely look at smaller companies concentrated on the most green activities with a lot of potential. But if you think about where value is today, and decarbonization potential exists today, it's in the larger diversified incumbents that have serious, achievable, meaningful plans to adapt their business models and their product mix to not only fundamentally benefit from the transition, but make meaningful contributions to real economy decarbonization, right? So you could look at those and say, like, this is a climate fund. What is integrated energy company A being in there? We differentiate, right? It's not benchmark hugging, but we're very selective about those kinds of names. And we think that they've got a lot of potential for alpha and decarbonization. So I wouldn't name names about which ones they are, right? But this is not a strategy that rests on exclusions or is backwards looking at thinking historical high carbon emitters are going to continue to be the historical high carbon emitters. We're really looking at decarbonization potential and the execution capacity and the financial strength that these companies have. Some of them have them, some of them don't. We like to own the one that have it.
Yeah, it brings to mind a comment from Garvin J. Bush at Green Alpha Advisors. He's just down the road from where you went to university, and he's got no hydrocarbons, hasn't for years. But then when he was on ESG and Coffee, I said, well, Garvin, and it was just after New York State had given their offshore wind project approval, and Ørsted was in there, Equinor was in there, and BP was in there. And I said, well, fair enough, it's going to be a tiny fraction of revenue for BP. But at some point, the energy companies, if they are getting their heads in the game of what we need going forward, they're going to be increasingly doing projects that's going to drive some revenue, which is in the direction. So I'm kind of nudging and teasing him, saying, okay, so what is the number? If it's 5% of revenue of a former oil major, if it's 35% of a former, or based on his strategy, which does certain things and so on. But at some point, you start to back in the new direction. And another example is AP Møller-Mærsk, the big shipping company. They are able to almost single-handedly help reshape shipping and kind of freight decisions based on the drivetrains that are used and how polluted they are, if they have the customers who will pay up front to help them kind of get through.
Yeah, that was circa Walmart sustainability initiative, circa 2007, right?
Yeah.
Right. That's the buyer power.
Yeah. Excellent. Well, it's been fantastic. Thank you so much for being on ESG and Coffee. And we have a show note. We'll grab as many of what you shared with us and put it in the show note. And thank you for helping me close out ESG and Coffee Season 1 so well.
I'm honored to be a part of it, Graham, and I'm glad that we finally got to it. Much easier for me now that I'm Allspring. So I am psyched to go back and listen to at least a couple of them. It wasn't lost on me that Bill Page's was the longest, because I know how he is.
And a colleague, a good man. I remember a fine meeting in a skyscraper in Boston.
Yeah.
Good man.
Yeah.
Okay.
Excellent, Graham. Thank you.
Well, I hope you enjoyed that conversation as much as I did. A little tight on time than before. Still a very rich and not short, long-form interview of about an hour and a half, I think it was. Here's my 5 high points. 1, quote, what we call human capital really matters, unquote. That was Chris during our conversation. Diversity is crucial, and not just in complexion or cognitive ability, but in how firms approach the problems they face and how they bring solutions to the marketplace. These were some of Chris's thoughts that I found very useful. Companies that have a purpose beyond just succeeding financially are firms that have a compass within their operating environment, the culture that will keep thriving through extreme economic stress like we've been experiencing during the COVID-19 pandemic. The data sets are not readily available now, I'd agree with that. But it has driven Chris and his colleagues' engagement with companies over this period, the little data that they have. I also include a link to the Deloitte CEO that I mentioned in the interview, both their survey of CEOs on climate and the interview I referenced on Bloomberg Live, where the Deloitte CEO says that 87% of firm employees wanted the firm to work on climate, so they're doing it. High point number 2, range of experience. Chris works across asset classes and investment strategy types, so he sits with different investment teams daily, working on mandates that cover growth equity, to overnight money markets, to you name it. Maybe he always has an open mind. I like this comment about, hey, I like any tree I'm looking at. In some ways, that's captured in his movie moments, from Trading Places in 1983 to Wall Street in 1987, a range of sometimes dark humor and tragic hero arcs. Most impressive is Chris's quality when he speaks candidly about where he checked his proposition to restate something that sounded like greenwashing, where a fund's description said, quote, fossil fuel free, unquote, when it was really, quote, fossil fuel reserves free, unquote. A professional who takes antagonistic criticism, processes it, and fixes their work, that's a human that does better quality work. Chris expects that greenwashing will reinforce the need to be better quality, and he offered me a new perspective that the upside is that legal and compliance are now forced to be sharper on what ESG is and is not, as they try and monitor that line. Short-term pain for longer-term gain. Third high point, tracking our impact. I listened closely as Chris thought through if and how he would update his seminal TED at State Street speech from November 2013, published in 2014. It's had over 1 million views on TED and even got a boost years later from the Kelper social media person. Nice one. Watch it for the historical context, nearly a decade ago now, with the opportunity to benchmark for an update today. At least that's what I intend to do with mine in late 2023. Reflect on how much or how little has changed. And Chris thinks only a little has changed. Some of the data points have changed, but the thrust is still there. As two humans who have been trying to make this path into investment, where all factors, including ESG factors, make up the investment decision, tracking impact matters very personally to us, as much as it matters for investment clients and the overall industry and state of the world. It was kind of Chris to reflect on that tagline that I've developed. The investments you make become the future we live in. And final high point, rating ESG performance. Chris's intellectual inquiry is reflected in the wide range of ESG data vendors that he and his team chooses to work from, but only as a starting point because ESG needs nuance and context. Chris uses the ESG ratings as third-party street view as reference set to test how his firm's ESG performance assessment maps as similar or different to whatever the consensus is. I raised the example of the 2018 paper on the social origins of ESG and analysis of Innovest and KLD, which I include in the show notes. It's a reflection of how the ESG research is done, how ratings are made, and where the points of opinion are versus capturing data points. Chris says we need to be in the spreadsheets, looking up at the client landscape and checking our biases. We are always rating our own performance, and so is the market. So I hope you stayed afterwards for the very short bonus tape where we talked about portfolio names that may be surprising, where Chris expounds upon climate transition with small and large firms, and where large diversified incumbents that have achievable plans that may benefit from the transition and may well help the economy shift faster are important. So I hope you enjoyed Season 1, Episode 12 with Chris Mcknett and all of Season 1. Thank you for listening.
We hope you enjoyed the interview with one of the originals in investing, strategy, and sustainability. Please subscribe on your favorite podcasting platform or on YouTube and leave a 5-star review. Bad reviews you can send to Graham Sinclair at ESG Architect. All the details are in the show notes. And for news of our next guests, follow us on Twitter or Instagram at ESG and Coffee. Do you know an impressive human we should absolutely interview on investment, strategy, and sustainability? Please let us know on Twitter at ESG and Coffee. Our producer is Kat Farquharson on Twitter at Kat Farquharson, and original music by Aaron Bonney on Twitter at Aaron Bonney Music. And of course, this podcast is for your enlightenment, not investment advice. Do your own research.
You have been listening to the ESG and Coffee Podcast on investing, strategy, and sustainability, hosted by Graham Sinclair.